Hi, hello, how are you all? Welcome to my channel Law Made Simple with me Vidya Reddy. Today, in the series of Law of Taxation, let us discuss a new topic, double taxation. What is this double taxation? Is the tax paid twice? How can it be relieved? How can a taxpayer get relief from this one source of income paying tax two times? So, double taxation is nothing but paying the tax twice on the same source of income. It can occur when tax is paid both at corporate level and personal level. Double taxation also occurs in international trade or investment when the same income is taxed in two different countries. So, double taxation generally occurs because the corporations are considered as separate entities from the shareholders. So, corporation pay taxes. They from their annual earnings they cut the tax and those dividends are paid to the shareholders. And when these dividends are paid to the shareholders, those dividend payments incur income tax liabilities for the shareholders. So, in that dividend payments also income tax liabilities when they pay the tax through that dividends, then there is a chance of double taxation. And double taxation is often an unintended consequence of tax legislation. It is generally seen as a negative element of tax system, and tax authorities attempt to avoid it whenever possible. So generally, for the same income, if you pay tax two times, that is in generally unlawful. So but because of this corporations, they have a tedious, they have a annual earnings from which they incur income tax liabilities. So from the shareholders the tax is taken, and from the corporations also tax is taken. So for the same income, tax is paid twice. So to avoid this, we have different methods of how to avoid or how to get relieved from the double taxation. So in general, this double taxation is nothing but tax being paid for one source of income two times. And in general, this occurs in the business level where the stocks, the dividends which the shareholders get through the stocks, they are actually they are paying tax two times, double taxation. And also this double taxation occurs when the same income is taxed in two different countries. So let us discuss what is this international double taxation. Generally, the international business are often faced with the double taxation because income is generated in one country where it is earned and then taxed again when it is repatriated in the business home country. For example, we have Max in India and also Max in Gulf countries. So, if suppose Max is the Indian brand, and if it is getting profits in Gulf countries, there the income is taxed, and also for the same production of the income it is taxed in India also. Then this becomes the international double taxation. So in some cases the total tax rate is so high, it makes international business very expensive. So to avoid these issues, countries around the world have signed hundreds of treaties for avoidance of double taxation. Generally, based on the models provided by the Organization of Economic Cooperation and Development, these treaties sign and agree to the limit of their taxation for this international business to carry out very smoothly. So in general, the international business is an effort to augment trade between two different countries and avoid double taxation. Can this double taxation be avoided? Yes, there is a method. That method is nothing but, that relief is nothing but double taxation avoidance agreement, DTAA. So the individual taxpayer can avoid double taxation only by this income tax provision where it gives the individual a relief from being double taxed. So this double taxation avoidance agreement is present. This provision is present in the Income Tax Act 1961. So what is this DTAA, Double Taxation Avoidance Agreement? This is a tax treaty that India signs with another country. An individual can avoid being taxed twice by utilizing the provisions of this treaty. Generally, they can either be comprehensive agreements which cover all types of incomes, or specific treaties targeting only certain types of income. Generally, DTAA between India and Singapore, under which income is taxed based on the residential status of the individual. This streamlines the flow of taxation and ensures that the individual is not taxed twice for the income and outside the India. Now India has DTTA in agreement with more than 80 countries. Now we have got a relief for the international double taxation by DTAA from the provisions of the Income Tax Act 1961. So for people, for the individuals residing in India, how a double taxation can be relieved? We have two different methods: unilateral relief and bilateral relief. So we have sections 91 of the Income Tax Act 1961 provides unilateral relief against double taxation. How? We have a provision whether whether the country has a relationship with a foreign country with DTAA treaty or not, but it has to satisfy certain conditions. For this, to avoid this double taxation and to get relief under unilateral relief against this double taxation. What are those conditions? This individual or corporation should have been a resident of India in the previous year, and the income should have been accrued to the taxpayer and received by them outside India in the previous year. So the income should have been accrued not in India but in other country, and the income should have taxed both in India and the country where there is no DTAA. So if there is a DTAA, obviously there is a relief, but the income should have been taxed both in India and other country where there is no treaty between the country and the India with DTAA, and the individual or corporation should have to pay tax in that foreign country. Then there is a chance of unilateral relief. So according to section 91, unilateral relief can be taken into consideration to avoid this double taxation. And what is this bilateral relief? Bilateral relief is covered under section 90 of the Income Tax Act 1961, and it offers two different methods: exemption method and tax credit method. What is this exemption method? If an individual wants to avoid this double taxation method and that income earned outside India has been taxed in the relevant foreign country and it is not a subject of tax in India. And tax credit method. According to this method, the individual or corporation can claim a tax credit for the taxes paid outside India. This tax credit can be utilized to set off the tax payable in India, thereby reducing the taxpayer's overall tax liability. So by utilizing these provisions of DTAA, section 90 and 91, 90 is for bilateral and 91 is for unilateral. So by utilizing these provisions, we can get a relief of double taxation, and individuals can minimize the tax liabilities and avoid the burden of double taxation. As such, we have come to the end of the session. It's riddle time. Please answer the riddle in the comment section. Please like, share and subscribe. Thank you.